Position trading is a trading approach centered on long-term market perspective and strategic positioning, yet it is often confused with shorter-term styles. Decisions are made slowly and deliberately, without the need for frequent chart monitoring. Instead of engaging with minor price fluctuations, the trader concentrates on major market phases that evolve over extended periods. A focus moves away from immediacy and toward vision, structure, and long-term alignment. In position trading, the objective is not to benefit from short-lived market swings. The trader seeks to participate in broader trends that can last for weeks, months, or even longer. Positions are designed to remain active through multiple market cycles, news events, and sessions. This method places the trader in sync with higher time frame direction rather than temporary movement within a single day or week. Because trades are maintained for extended durations, analysis becomes more comprehensive and intentional. Entry zones, risk exposure, and profit objectives are defined using macro structure and higher time frame context. Once a position is established, the main challenge shifts away from execution and toward discipline and conviction. The trader must tolerate pullbacks, volatility, and periods of stagnation without deviating from the original thesis. Welcome back to the ComLucro channel. This video is part of our Types of Trading course, a practical series where we explore each trading style through real market behavior. In this chapter, we focus on position trading as a long-term decision-making process. We will break down how position trading works, which timeframes guide analysis, how positions are managed over long horizons, and which trader profiles are best suited for this style. If you enjoy this kind of content, make sure to like the video, subscribe, and turn on notifications so you do not miss what comes next. And let us know in the comments what topics you want us to cover next. You will also find links to our trusted partners in the description. When you use those links, you help support the channel and keep this content moving forward. So, what position trading really is? Position trading is a long horizon trading style built around participating in major market trends rather than short or intermediate moves. The goal is not to respond to day-to-day price changes, but to establish exposure in the direction of dominant market forces visible on higher time frames. With this approach, positions are initiated with the intention of remaining active for weeks or even months. Trades stay open through multiple sessions, macro events, and market cycles. Results come from aligning with long-term direction, controlling risk size, and maintaining conviction, not from frequent entries or constant decision-making. Position trading relies heavily on broad market context and structural alignment. Entry areas, invalidation points, and objectives are defined using weekly and daily charts, often supported by macro conditions. Once a position is live, management is minimal. The focus shifts to staying consistent with the original thesis, rather than reacting to normal pullbacks or temporary volatility. Because of this, position trading is not about watching charts every day or adjusting trades constantly. It is about patience, clarity, and trust in long-term structure. When this perspective is missing, position trading turns into emotional exposure or uncontrolled risk. Position trading is not buy and hope. It is a disciplined method of managing opportunity over extended periods of market development. Now that we move beyond swing trading, the next step is to understand how position trading shows up on the chart. Position trading is defined by very high time frames and long-term market structure, not by short-term price movement. Traders focus primarily on the daily, weekly, and sometimes monthly charts to identify major trends, key zones, and long-term directional bias. Trades in position trading are designed to remain open for weeks or even months, depending on how the broader market unfolds. The exact holding period is not the priority. What matters is staying aligned with the long-term thesis, managing risk conservatively, and giving price enough time to develop without interference. This level of patience and conviction is what defines position trading and separates strategic traders from those who still react emotionally to short-term movement. Let's talk about trade frequency and structure at this level. Position trading is not built around being active in the market all the time or placing trades every week. Most position traders take very few trades over long periods, sometimes only a handful per month or even per quarter. The focus is always on high-conviction opportunities that align with long-term structure and dominant market direction. Structure still matters, but it operates on a much broader scale. Clear rules are defined for entry, risk exposure, and long-term management, including how to sit through deep pullbacks and extended periods of consolidation. Without this framework, long-term trades quickly turn into emotional exposure rather than intentional positioning. Position trading works best when decisions are made upfront and discipline is maintained for as long as the market thesis remains valid. Let's weigh the strengths and limitations of position trading. One of the biggest advantages is clarity. By operating on higher time frames, the trader is less affected by daily noise and short-term reactions. There is more time to study market context, evaluate long-term direction, and build positions without urgency or constant pressure. Position trading also allows participation in major market trends. Because trades can last weeks or even months, potential moves are significantly larger. Fewer decisions are required once a position is active, which suits traders who prefer planning, structure, and conviction over frequent execution. On the other hand, position trading demands a high level of emotional resilience. Positions remain open to news events, pullbacks, and long periods of consolidation. The trader must tolerate swings in unrealized profit and loss without reacting impulsively or abandoning the original thesis. Transaction costs are typically low due to the small number of trades, but risk can grow quickly if position size is too large or invalidation levels are poorly defined. Position trading is psychologically demanding in its own way. It rewards patience, discipline, and trust in long-term structure, but it quickly exposes fear, doubt, and the need for constant control once a trade is in progress. Not every trader is built for long holding periods and delayed feedback. Position trading tends to suit traders who are comfortable thinking in terms of weeks and months instead of days. It fits those who prefer analysis and planning over fast execution, and who are not driven by the need to be constantly active in the market. This style requires a strong level of emotional control over extended periods. Profits and losses develop slowly, and positions often go through deep pullbacks or long phases of consolidation before resolving. A position trader must remain calm and committed, allowing the market to work without reacting to normal fluctuations. Discipline plays a critical role in position trading. Screen time is usually low, but the real challenge is resisting the urge to interfere with trades once they are placed. Adjusting positions too often or second-guessing the original thesis usually comes from impatience, not from market logic. Position trading also demands comfort with uncertainty and long exposure. Trades stay open through news cycles, macro events, and changing sentiment. Losses are part of the process and must be accepted strictly according to predefined risk rules. For traders who value clarity, patience, and long-term vision, position trading can feel natural. For others, the slow pace and lack of constant feedback can be mentally uncomfortable. Recognizing this fit is essential before committing to this style. Beginners often struggle with position trading for reasons that are more psychological than technical. One of the most common mistakes is entering positions without a clear long-term market thesis. Because position trades last for weeks or months, entries, risk levels, and invalidation points must be defined using higher time frame structure. Without this clarity, traders start reacting emotionally to normal price movement and lose direction. Another frequent mistake is interfering too early with positions. Small pullbacks, temporary consolidations, or short-term news reactions are often misinterpreted as failure. This leads traders to exit positions prematurely or adjust risk without a valid structural reason. In most cases, this behavior comes from impatience and a lack of confidence in the original long-term analysis. Many beginners also underestimate the emotional pressure of holding exposure for extended periods. Position trading involves sitting through drawdowns, slow progress, and long phases where nothing seems to happen. Watching unrealized profit and loss fluctuate over weeks can trigger doubt and impulsive decisions if clear management rules are not in place. Another common issue is confusing position trading with passive investing. Some traders hold losing positions beyond their planned risk, hoping time alone will fix the trade. Poor position sizing and excessive exposure can quietly cause significant damage, even with very few trades. In position trading, discipline and risk control matter more than activity, and ignoring them turns a structured approach into uncontrolled exposure. To wrap up, position trading is a long-term trading approach built around clarity, structure, and disciplined decision-making. It is not about reacting to short-term price movement, but about aligning with major market trends using clearly defined risk. Position trading rewards patience, conviction, and trust in higher timeframe structure, and it quickly exposes impulsiveness, emotional interference, and the inability to stay committed to a long-term plan. Please also remember that the mission of the ComLucro channel is simple. We focus on giving traders clarity, confidence, and structure, so market decisions are made with discipline and intention. On this channel, you will find complete courses built as a true trading masterclass. We teach market structure, higher time frame trading, and supply and demand, always focused on understanding price behavior and executing with a professional mindset. We also go deep into trading psychology, risk management, and consistency, because trading is not just about charts. It is about mindset, discipline, and structured execution over time. There are no shortcuts. Real progress comes from continuous learning and practice. Our main courses include smart money concepts, technical analysis for day traders, trading psychology, and the Wyckoff method course. Alongside our courses, we share lessons and insights from some of the most respected names in trading, including professionals like David Paul, Alexander Elder, Tom Hugard, Mark Douglas, Al Brooks, and Larry Williams, whose experience has shaped how traders understand markets today. So, if this video helped you gain more clarity, leave a like. It helps this content reach other traders who are on the same journey. Make sure to subscribe and turn on notifications so you don't miss our latest lessons and insights. Now, I would really like to hear from you. Which concept in this video made the biggest difference for you? What topic would you like us to cover next? Leave a comment below and let us know. If you want to go deeper with exclusive content, early access to videos, and additional tools to support your development, consider joining the ComLucro Trader community right here on YouTube. It is a simple way to support the channel and a smart investment in your own growth as a trader. Thanks for watching, and I will see you in the next video.